what I wanted to really break down, and it's just for anyone that's going to be watching this afterwards as well. As mentioned, while I was away, I tried another approach of just leaving a trade in and sort of not thinking about it, setting a much wider stop, a bigger target, and just completely letting it run. It's not something I usually do. I consider myself a day trader, not a swing trader. I like to be in and out of the markets and keeping my risk to a minimum. And the point that we got in was around 14.17, and was looking to take it up to 14.38, sort of around this area. Now would have been around this day from when I was away, when we had a pull down and started coming back up, and it was here that I thought, right, I like the look at this, and that's where I'd gone long. Now, throughout that trade, we are just back up above that level now since 23rd to the 1st. So over a week, over several trading sessions, we're just sort of there. But in the meantime, it's done big moves to the upside, move to the downside, and another big move to the upside before sort of crashing down, thanks to the rate cut from yesterday. But over that whole journey, what I'd done after this point, when I was sort of back in the charts, I'd locked in sort of 5% on the trade, so around sort of 14.22, and then let it run. It was when I started to see the pullback. Let it run. At one point, you know, it was up almost 20%. Could have taken it out, but I thought I'm just going to leave it. I did actually move my stop up to lock in 10%, but then it started coming back down, and I thought, you know, I'm gonna adjust it back. I was cutting it a bit tight by moving it up, so I basically pulled it back down to the 5%, and which was below the 50 here, and it just crashed through and stopped me out sort of yesterday evening. So I come out of that with 5% over a week, which, you know, minus the second trade that I did that knocked me out for another 1%, but that was a 1% loss, so 4%, minus the fees that I had, which was, it was over 1%. I actually calculated it all up earlier on. It was nearly 1.5%. It means I pretty much end up with 2.5% from that one trade in that whole time. Now, some people will still think, oh, that's pretty good, that's a week, that could be 10% a month. But what we're used to as technical traders, and the way that I trade, is looking for 1 to 5% moves that can happen within a day, and taking advantage of those, not being afraid to take my profit when I see it, and sticking to that. So let's just work out what we could have had. So if sticking to the standard strategies, let's break down lower time frames so we can see where we would have exited and re-entered, etc., so that it's completely clear. So it would have been around here then that we got that pullback and came up on that 4 hours. Where is it? Yeah, it would have been around here somewhere. So yeah, so right here, and after seeing this sort of bearish candle would have come out. So at 24, that would have been 7% banked at that point. Because I had a bullish bias, I probably wouldn't have bought in again here at this point, in honesty. Although you could have, you know, you could have held that to the longer run. I probably would have waited until I saw this, or even this, where we had the nice bullish candle back breaking above the 1 hour 20, and then we had, that's at 14.20, and come out again. I probably would have come out after seeing this sort of double top. I probably would have ended up out around here. So another 5%. So That's 12%. Again, I probably would have got in here looking at this nice bullish candle. I wouldn't have exited here. I would have been in there and I would have been holding through here, and would have just kept an eye on make sure it didn't come below the lows. And then probably would have been exited out here. I mean, I had an eye on this sort of 30 mark, so I would have actually come out there. I wouldn't have taken out the top. But that is 20 to 30, that's another 10%. And we're looking at 32%. And then we had the crash down. I wouldn't have been selling. So again, I would have been waiting for an opportunity to go long. So it would have been this sort of candle that I decided to go long at 14.16. So lower than I originally had got in. And that then I would have ridden. I mean, this was the build up to the to the rate cut and stuff. Again, as I said, I was waiting to see what happened. So I'm not going to pretend I would have come out when it's optimum moments. I would have come out after this candle on the news, which let's say around 14.28. Not right at the sort of peak here. I would have seen the break of the 20, and that would have been my sort of cue to get out. But 20 and 16 is another 12, so it could have been 44% from that. And then, not to say I would have capitalised on the short movement here, but like earlier on, definitely, I've got in here earlier on and I was out 14.14. So, but in total, versus the 2.5% gain, could have had a 40% move. On top of the 20% I'd already done before I went away, could have been a 60% month if I was sat in front of the computer. Gold's movements was just perfect. It's just everything that we look for, and we look for those moves above the averages. We look to see everything's lined up, and I can break this down onto the higher time frames and show you how the 20's above the 50, and therefore that's why I was still staying long. And I expected the cut to happen. Admittedly, I expected it to have a very different effect. But what we're seeing now could have been just the fake move. I mean, you take a look at the Dow, it's recovered 300 points today. Where is Dolly? And that's sunk. That's had an incredibly bad time since reaching some highs. And you will often see in the markets, as I've said, it will show you the left before giving you the right. So it could have been a bit of a bull trap on the dollar, catch people out before it's sinking. Time will tell how markets really perceived it. I haven't caught up yet on the discussions after from the FOMC to break that down. But from what I can see, I mean, you just look at this bullish trend. I've got no reason to think there's not going to be more bullish momentum after that. Potentially up to 14.30. I'm going to wait for the break of this 4-hour 50 before entering on again. But then I'll take that up to 14.30. So if I can squeeze another 5% in between there, I'll be very happy for the start of the month. But that is my 2 pence worth on the day trading versus looking at daily candles and looking at swing trading. In that whole time, yes, made a little bit of money, but I could have made a lot more if I was visibly active on charts, which I wasn't. So that's fine. So regards to stops, if it breaks the 50, I'll probably have it below that 14.14 mark, which is the daily 20. As long as it holds above there, I'll be quite happy. So I'll be looking for the break. What I want it to do is look something like this. It's gone above the 50% mark, so it's showing some good momentum. But what I would expect to see, looking at it from the other way, is to continue from here up somewhere around here, perhaps to the 30, and then sort of come back down and retest this kind of area, and therefore the stop should be around 14.10. But because I just want to keep it tight, I'm going to look to keep around 14.14. So it's going to be about 60 pips stop, but then I'm going to look for pretty much 100 pips gain. So I'm quite happy with that as risk reward. Generally I look for a bit more, but I'm just conscious of this 1430 level. May break, may get to the 38 or get even higher, but being conservative, that's what I would like to see. If we get a candle on this 4 hour that finishes somewhat like it is now, I won't be entering because it will continue to the downside. It's not a dodgy kind of doji like that, but I think that's very unlikely to happen. Looking at this, looking at the dollar, and if we look at the dollar index, that in itself is saying I'm on my way down. So, let's take a look at the daily. That could carry on and really become a big move down to this sort of 97.5 mark here. It could be a complete fake out. So, back bullish on the gold. Yeah, the non-farm payroll could make a move. You're absolutely right. It could make a move in either direction, as we've seen from yesterday, just because it's physically not very good. I mean, I can't see how a rate cut can be positive for the dollar, not in the longer term. But that's just my opinion. So we will see how that comes out tomorrow. But that's why I'm not aiming for a big move, and I will manage accordingly. If we get that break above, and we're staying above the 5-minute 50, for example, I expect these to sort of catch up. If we're somewhere around 1426, 1427, or even lower, and I see it turning around and break back below the 5-minute 20, then I'll just exit the trade. I'm going to be managing that the best I can tomorrow. So if we get the break, like I say, I'm going to wait for the break and retest that 4 hour 50 before re-entering. But that, I hope, breaks down and explains the difference of day and swing trading and holding it in and leaving it versus just sticking to the strategy on the day trades. It's very rarely that I leave things in for more than a day or two, in which case, the fees and everything else doesn't really have much of an effect. But yeah, I hope it's a useful webinar nonetheless. Yeah, absolutely. I far prefer it. I prefer sticking with strategy. I like being on the charts. I'm fortunate that I do this all the time and full time, and there isn't a day normally that I don't look at the charts. But I thought for an experience for me, and also because I've had a lot of people messaging about day trading and just looking at patterns and this different things, that I wanted to alliterate that. As much as, yes, you can win and there can be a big move, when you lose, you're going to lose a lot more. And at the same time, what you can actually make in between any of those moves is always far greater. You just need to know how to do it. If we looked at it on the 1 hour or 30 minutes, and every time we had a bounce off of it just took a couple of percent, even from that point when I entered the trade, it was around here. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 reactions there off of the 1 hour 20, which could have provided long opportunities. Even just taking the 20 pips, 2% off of each one, that would have been 20%. It would have been a lot more than I ended up with. As I say, even Optimum, by taking it out yesterday, if I took it out at the sort of 32 mark, that was 15%. Still, minus the fees, not ideal, but nonetheless, didn't lose money. On top of the 20% I'd already done, it was a nice healthy month, but was at one point it was going to be one of the best months I'd ever had. So, but it just goes to show, that's trading for you. So I hope that was useful.